Hi, everybody, and welcome to our first-time homebuyer seminar. This is a homebuyer seminar, not just for first-time homebuyers, but it's open to anyone looking to purchase a home. Over the last few years, so many things have changed, and this session is going to be an amazing opportunity for you to find out what it takes to buy a home in today's market, whether it's your first home or second home, or you owned a home 10 years ago and you're looking to get back in the market. We're here to guide you through that process and help you build wealth through real estate. My name is Anthony Voland, and I'm the broker and owner of the Collective Realty. We have about 50 agents that serve the greater LA area, even other parts of California as well. We're very passionate about helping our clients really understand how to build wealth through home ownership. And today's session is on how to get into the game. How do you start? How do you get on that path? Why is owning a home so important as opposed to renting, as far as building wealth and for your future? We do a lot of other seminars on once you're a homeowner and maybe looking to purchase an investment property, or how to protect your wealth through putting your property in a trust, through ADUs, through so many other options. And all of those other videos are posted on our YouTube channel. So if you search the Collective Realty on YouTube, you'll be able to find out all the other ways to build wealth through real estate. But today we're going to focus just on purchasing your home, and maybe this is going to be your first home. I know for me, this is my passion, is trying to make sure people really understand how to build a future, where they have income and they feel safe and stable. And we really have just found, through home ownership, this is still the #1 way that people are building wealth in our country, is through real estate. So I'd like to introduce you to our panel. Let's see if I can get everyone on here. I think y'all should see everyone now. We have Tim Tobish, who is a realtor at the Collective, and he's going to be chiming in on the real estate experience and on why owning is so important in his personal story. We have Marty with Arcstone Financial, and we have Natalie with Movement Mortgage. They're amazing lenders. They work with my clients, and I would trust them with anything that I did. They're a wealth of knowledge, and they're going to talk to you a little bit more about how their companies even are different than big banks. A lot of people assume that, when I'm going to buy a home, the first thing I do is go to Wells Fargo and apply for a mortgage because I already have a checking account there. We've learned that that's usually not the best thing to do. You might not get the best rate, and it might be much harder to qualify at a larger bank. So we'll introduce you to some of the things that they do, and they're going to take you through some of the myths about down payments and what types of down payments are available for who, how much income you need to qualify. They'll talk briefly about credit, and then just kind of the process of going through escrow and what the appraisal looks like, and so on. So we're going to have kind of like a panel discussion here, and any of you who have questions, there's a question box at the bottom. Please feel free to ask a question and we'll get it answered. If you'd like to ask your question live, you're able to do that. I can unmute you and you're able to ask the question live. So we would love as much interaction as possible. So please feel free to do that. But let's get started with Tim. And I'd like Tim just to talk a little bit about why it's so important to consider becoming a homeowner rather than renting, and your personal story and how that's helped you accumulate wealth in not very many years. I mean, you've accumulated more wealth than an average person would just by having a job that increased their salary every year and so on. Having home ownership is it's such an amazing way to build wealth. So I'm just going to pull it over to Tim. Tim, you want to unmute yourself and talk to us about why renting versus home owning? Why? What the heck? Why are we here?
Hi, I'm Tim Tobish. I'm a realtor with Anthony at the Collective. Just want to talk about, I'll end with my own experience. I'll give a brief description of the rent versus buy scenario, and what's going on with that and why you should consider buying if you are renting. First off, rent versus buy. The difference, rent goes up, mortgages remain the same, so your home buying payment remains the same over time. It's your house or your condo or your property, it's your rules. You can make whatever improvements you like. without answering to anybody except maybe a homeowners association, but that's a fine point. But any improvement you make is yours, and you will add to the value of your house up to and including what you put into it. Otherwise, you're just giving it to, it's basically a gift to your landlord. Also, people don't really think about this as first-time home buyers, but when you're paying your mortgage, a big chunk of that, especially at the beginning, is mortgage interest. That's tax deductible. So you very well might find that you get a huge tax savings your first year. People are always pleasantly surprised when they're not anticipating it. But every dollar that you're going into that mortgage interest is $1 off of the top bracket of your income tax that you're paying. I'm sure that our brokers will talk about that further. Most importantly, you build wealth. When you pay for a mortgage, you're paying yourself. You're basically putting money in your own bank as you pay back the principal part especially. And you're building equity in your house. Rent pays your landlord's mortgage and builds their equity. It's basically it's a simple cost to you. You don't get anything out of it, except for the ability to live in a house. And I'll talk about that in a bit. The equity in your primary home can also be leveraged to buy additional property or make other investments. A lot of people start their wealth building journey with buying their first property and building on that equity. Now, of course, there are lifestyle advantages sometimes in renting. You're able to afford to live in an area where you're priced out to buying. I did that for years in Venice. And you might have a really great rent control apartment in an area that you like, which is great for a time, but I just want to really address what you're giving up if you stay there indefinitely. I wanted to start with a short scenario. Here's the rental part of the scenario, which is roughly equivalent. If you're paying $4,000 a month in rent for 5 years, which is not uncommon in Los Angeles, especially for tech workers working on Silicon Beach, finance people working downtown, especially millennials just starting out, they're still renting at this price. And so $4,000 a month, you increase it by 2.5% a year. Your first year, you're at $48,000. At the end of 5 years, you've paid over $250,000 in rent.
Tim, did you want to share your screen?
Oh, I thought I was.
No. Yeah, these are going to be helpful for people to see. Sorry. Thanks.
Oh, absolutely. I'm having a difficulty doing that.
Well, Tim's trying to share, if he can. Just a few of the points to touch on that he said is basically every dollar that you're paying into your mortgage is a positive dollar, right? So you're either paying towards interest, which you'll get back in tax deductions, some of that money back, or you're paying to pay off of the principal, which is basically like you're paying yourself. It's going right into your bank account, and you will get that back later for sure. So when you're paying rent, you get nothing back. So your screen's up. It looks great, Tim.
Awesome.
Go ahead.
Sorry about that. Okay. So to go back to where we were, I think I talked you through the advantages to buying over renting. I don't think we need to revisit that. But here's the scenario. Again, $4,000 a month in rent. $4,000 your first year, increasing by 2.5% a year. At the end of 5 years, you've paid $252,000 in rent. And you have zero equity. In the purchase scenario, where I'm assuming it's a $1 million house and you're putting 10% down. So you're putting down $100,000. That is not necessary. That's just for the case of this example. You could use a lower priced house. You can also put down as little as 3.5% or even less under some scenarios. Again, the brokers will talk about that. But that's basically ending you up with a total monthly payment of just under $4,000, which includes your mortgage, private mortgage insurance, which again, the mortgage brokers will talk about, your property tax, and your homeowner's insurance. So you're at about the same amount. So in 5 years, you've spent $238,000 total. If you include the down payment in that, so that's roughly the same as what you paid in rent, maybe even a little less. If you include the down payment as part of that investment, you're at $338,000. You're above that, adding the $100,000 in. But the punchline is look at the equity line. You don't have zero like in your rental. You have almost $500,000 in equity in this house. And if you that assumed a 25% appreciation on that house, which is not unreasonable. Here's a look at 10 years of appreciation in Los Angeles County, the state of California in general. Median home prices roughly went in 10 years from $300,000 to $6. So a 25% in 5 years is not unreasonable. If anything, it's probably a bit low. I'm talking a lot about equity. Let's talk a little bit about what equity is. The finance MBA kind of definition is it's the difference between what is owned and what is owned. In other words, the market value of your property less what you still own on your mortgage. This equity is not just money you can cash out again when you sell the house. You can you can borrow against it a number of ways to do remodels, additions, which again build about as much equity as you're putting into it. If you're undergoing financial stress, you can tap into that money. If you want to start a new business, you can tap into that money, which I did to start my real estate practice. You can equity leverage. A lot of people have made a lot of money in California this way. You buy additional investment property, and then those properties appreciate, so you're building even more equity. So it's a wealth building scenario, paying the exact same rent in mortgage.
Okay, yeah, and that's what we're seeing right now is a lot of the rents, the market rents, are similar to what the mortgage and interest and tax payments would be for buying a house. So it's making so much more sense now more than ever to purchase a home rather than rent, especially if you're looking for a rental property now and you're not in a rent control place where you're paying something really low but you're paying market rent. It doesn't make sense.
Yeah, and also your rent will go up. It's a little bit under rent control, but there's always the chance that building gets sold and then you're thrown into the market and you'll find out that market rent is way higher than what you were paying. I wanted to give a little bit about my story. I wasn't yet doing real estate and I didn't know a lot and I made some big mistakes. I was living in Venice in a front house. Back in those days, it was near Gold's Gym, near where Google is now. Venice hadn't really started to come up. So the ask price on the house when my landlord sold it was $335,000. So I did the numbers and I started playing with everything, and I didn't go for it because I was $20,000 short of 20%. Because at the time, I bought into that myth. It's simply not true that you need 20% down on the house. Long story short, this house is now worth $2.2 million on an investment of $335,000. So instead, in 1999, I moved to another beach shack a few blocks away and started at $1,475 a month. I stayed there till 2013. At the end, the rent was $2,200 a month. I had some money from an inheritance that I grew through some, reasonably prudent investments to double it. And then I finally had my 20% down. So I bought my house in Leimert Park in South LA in 2013. So I lived there for 13 years, loving it. It was a great experience. Venice in those days was a blast. It was a total circus. It was 5 blocks from the beach, 2 blocks from Rose, 3 blocks from Abbot Kinney. But unfortunately, I gave something up. Now I bought the house in 2013 in May for $400K. Just a few months ago, it appraised at $1.1 million, which is almost a 300% return. And I have over $500,000 equity in this house now. I went to a much nicer place, actually. I went from a 650 square foot little shack on the beach, 2-bedroom, 1-bath that I was sharing, to a $2,100,000 square foot house. 2,100 square foot house. 3 bedrooms, 3-bath. My mortgage all in is about $2,000 a month, including all the things I put into in the example I gave. When I left Venice, that little beach shack went from $2,200 a month to over $6,000 a month. So had I stayed, I wouldn't be able to afford to stay in Venice anyway. And had I stayed at the current rate amount, I would have spent roughly $100,000 in rent and come out with no equity. Instead, I have almost $500,000 equity in this house. At the end of the day, I love living in South LA more than I love the beach. So those lifestyle things do catch up to you. So one last bit of information that I wish I had done differently is I did exactly what Anthony mentioned in the discussion. Not knowing the difference, I had a checking account with Chase and I financed with Chase. I got through it. It was difficult, and I was doing it myself mostly and constantly going back and forth. And at sometimes big bank loans can fall apart, and you really don't have much of a recourse. I wished I had used a mortgage broker, and I would very much suggest anybody buying a house to do so. And with that, I will turn it over to Marty and Natalie, our mortgage brokers.
Hello, everyone.
Awesome. So, I mean, I guess, Tim, if you want to, I think you need to stop your screen share, and then we can see everyone else. But the point of the story is through home ownership, it creates, to me, what I've learned from the story is stability. You know, even if you're on rent control, you still have rent increases, and you're kind of stuck there, right? Through home ownership, you have a mortgage that's not going to change. The price that you're paying every month, no matter, you know, if it's today or if it's in 20 years from now, is the same. You don't have that with rent, even with rent control. You have that stability. Also, you have amazing tax deductions, and you're building equity and you're building wealth. So it's a no-brainer. Now let's get into how the heck can we qualify it? How does that going to happen? Marty, Natalie, maybe Natalie, if you want to start and just let us know, like, a little bit of how people can qualify for a loan. You know, how much money do they need down? How much money do they need to make? I'm sure people that are listening to us right now are like, I want to buy, but I don't think I can buy. There's no way I can afford a house in LA. Let's talk a little bit about that and see maybe if they are, or maybe in a year from now, they might be able to.
Sure. So I think the biggest, you know, misnomer in this business is that people think you have to have 20% down in order to purchase. And that's really not true. Not even close, actually. I would say very few of my clients have 20% down. Most of them have 10%, 5%. I do a lot of FHA loans where you only need 3.5% down. And we even have loans with options of only with 0% down now. So really, that shouldn't hold somebody up. Also, a lot of people think that they need to have no debts and pay off all their credit card debt. And that's also something that's not true. We always like to advise them of what debts should be paid down, if any are needed to be paid down at all. So it depends with how they're qualified, what their income looks like, to what their debts look like. That's how we qualify people. We take what your debts are. So we look at the debts on a credit report, and there's only a few that show up on a credit report because the only debts that we're looking at are actual loans that you've taken out, which is car, student loans, mortgages, of course, and credit cards. That's basically it. Unless you're like self-reporting utilities or something, we don't look at utilities. We don't look at cell phone bills. We don't look at insurance. We don't look at things like that. Look at the debts that are actual loans that it is, and student loans. So we take those debts per month, and we take the minimum due. So whatever shows up on that credit report as your minimum monthly due, that's what we take. We add those up. We add up what a potential mortgage payment would look like, and then we divide it by your income. It's actually really simple. You can kind of get an idea for yourself if you add it all up yourself.
Is it cutting out for you guys as well, or just, yeah?
Double star. Occasionally, if it's optic.
Okay, we're gonna go to Marty for a second. It's just cutting out a little bit.
I am.
Yeah, just
That's
it's a little
so weird. I've got like a ton of bars, and I'm sitting still.
sound beautiful right now. So why don't you try to keep going?
Oh my goodness. Okay. Yeah, I'm sitting still, and I have a lot of bars, so I'm not sure. What, Anthony? What's the last thing you heard?
Oh, it says Natalie's bandwidth is low. So yeah, I mean, I guess the main point then, Natalie, we'll get back to you in a second. Maybe it will come back.
Okay.
The main points were, look, you don't have to have 20% down. Many of our clients are buying with much less. 5 to 10% is pretty common. And it's just something to think about. So there are programs that you can buy 3.5% down. Marty, do you want to maybe mention talk about FHA and other even lower down payment programs? And
Sure.
it doesn't, not everyone qualifies for it, and you can't buy $1 million house with it, but you can, tell us.
Absolutely, yeah. So with the lower down payment programs, I mean, you've got, as Natalie mentioned, you could do 0% down, 3.5% down, 3% down. There are variations. So we could go into all the variations of down payments, but the whole point of it is that you could do very little down payment to not deter that from, make that into a deterrent from you buying a home. The whole goal is to have a conversation with someone that's a professional that knows these products, and give you a little bit of a direction as to what you could qualify for. So with that said, yes, absolutely. 0 down, 3.5% down, 5, 10, 20%, these are all available. The 3.5% program that Anthony was mentioning was a minimum down payment program with HUD, which is the Housing and Urban Development. We call it FHA, which is a first-time home buyer program. And that allows you to basically put 3.5% down. And the guidelines on an FHA loan is what's favorable for a first-time home buyer that might not have excellent credit, that we're not always doing the right things to get to that point where they would have a 720 or 740 credit score. It allows for lower credit scores. It allows for higher debt to income ratios, as Natalie mentioned. If your income is a little bit lower than the regular conventional loans would allow for, you could obviously qualify for a loan still, whereas some other loan programs and other lenders may not do FHA loans, will not be able to provide that for you. So the goal is to work with someone that has an all-encompassing loan programs and is able to go from one loan program to the other. I really wanted to talk about the loan process, if that's all right with you.
What's the loan limit for FHA?
The loan limits vary in different counties. So in Los Angeles County, we could go all the way up to $765,600. And in various counties, it varies. I mean, obviously, if you go to Orange County, it's going to be the same as LA. But if you go to Ventura County, it's going to be a tiny bit lower. So there are variations of various counties that you could go to. But Los Angeles, if we're focusing on it, you could go all the way up to $765,000, which is a pretty big dollar amount for a single family residence. Now, if we go for a duplex or a triplex or even a fourplex, those numbers will change. I mean, they could go all the way up to I believe a fourplex goes to 1.472. We could get an FHA loan with 3.5% down with $1 million of a loan amount of $1,472,000. I mean, you can't really do that with any conventional loan types or bank portfolio type loan types as well. So it definitely gives you a little bit of an advantage to get into a property that's higher valued. But just overall, as far as going back a little bit, I really wanted to talk about the loan process. There's variations of items that we do, and that's, a loan pre-qualification is a word that you probably might hear. A pre-approval is another word you might hear, and an approval is another one that you would hear. So pre-qualification, I just want to make sure that, a lot of people go to the banks and they talk to a very basic conversation with a loan officer, and you can get a pre-qualification letter that doesn't involve you getting involved in your income or your credit reports or things of that nature. Very, very high level, and probably not something that you want to hang your hat on. Pre-approval is going to be something that a loan officer is going to review your documentation and run your credit report and give you a pre-approval letter knowing that your loan is pre-qualified. And there's also another step, and that's called an approval, where your file goes to an underwriter, and an underwriter actually signs off and says, yes, you're fully approved, which is probably the best thing you could get when you're actually writing an offer. And it makes it where, the realtor has a lot more of a bargaining power with your transaction. I mean, and I'm sure,
So how does, absolutely, a pre-approval and a full approval is better, but why wouldn't every client get a full approval? What do they need to do with their lender before they write an offer?
So an approval process is a little bit more intense, I would say. It's going to include for you to provide every pay stub, every bank statement, every tax return that we would actually need, and it goes to an underwriter. Now, you would have to provide that documentation for a pre-approval as well. But once you get an underwriter to approve your loan, that means that it's gone through the entire process of the loan process, and
So
that would
once I submit my package, how long does it take for the underwriter to tell me I'm approved?
it all varies, right? Like, so timelines right now has been a little bit longer. It could go up to like 3 days for a
Oh, quick.
yeah, it's a quick process.
Okay.
Generally, it's a lot faster than that. It's about 24 to 48 hours, but it's gone a little bit longer because the rates are so low, right? Like, everybody's refinancing and it's been an influx of business. So things have
Yeah.
a
So
little
the
bit.
point is get your package into the lender, ask them to send it to underwriting to get approval before you start writing offers, because we are in a very competitive market right now, and we definitely want to make sure that um, that you have an opportunity to get the house that you want when it comes up, but you're not going to have that opportunity unless you have that full approval. So get the full approval and then start looking for properties. If you got an approval a year ago, guess what? You're in luck, because rates are much lower now than they were a year ago, and your purchase power might go up. If you were approved for 700,000 a year ago, maybe you're up to 800,000 or even more. So it's definitely something you want to stay on top of and talk to the lender about your personal situation and find out what it is that you can qualify for at this moment. Um, what I like to guide my clients in saying is that, you know, it's not it's not what can I get qualified for, you know, but you know, as my client, I would tell you that tell the lender how much do you want to spend, how much can you comfortably afford to spend per month on a house, and if that number is 3,500, and say, look, I can afford 3,500 to include my taxes, insurance, everything all in, then ask the lender, can I be approved? What does that, what purchase price can I be approved for if I can spend 3,500 a month? And then go through the process backwards. So it's not just like throwing in all your numbers to them and saying, oh, you're approved for $1 million home. That $1 million home might not give you a payment that you're completely comfortable with. So make sure you start that conversation with what are you comfortable with spending? And then let's see what we can qualify you for. So then they say, okay, you know, you could qualify for $1 million, but in order to get the payment you want, you're going to be spending, you're going to need to look at houses around 750,000. That's the number we need as a realtor. Now that you're going to be comfortable with. So now Tim and all the realtors out there can go help you find properties for 750,000, and we can discuss the differences between condos and homes and living in the Valley or living in South LA or living in West Hollywood and all that kind of fun stuff, and then go shopping. So just understand that you as a buyer are in control, and the lenders are here to help you and guide you. And go through that process. So, sorry, go ahead, Marty or Natalie. Anything else about getting qualified? Then we're going to move on to the next section.
It's just, I think I wanted to throw out there like a needs list of what somebody needs to realistically understand, what they need to put together. And that's going to be generally your income taxes, your W-2s, if you're a corporation, you're going to need to put your corporate taxes together, your bank statements. Those are really the most important things. Compile those together. I know they seem daunting, but compile them together, put them on your desktop somewhere, because we're going to need to get those things to basically calculate. And what Anthony said was very, very valid. It makes our job a little bit easier if you have an idea of what your spending power is on a payment, on payments. I'm happy. I mean, we could always go the first way, where you could give us your documentation and we could qualify your income based off of your income. And then you might say, all right, well, the income level, you know, you might sometimes qualify for a lot higher of a payment amount, but you might not be comfortable paying the $5,000 a month payment. So those are the things that, you know, as Anthony mentioned, is very important for you to know what those monthly payments that you want to put out, essentially. But the other pieces are going to be knowing your credit. Credit is a big piece of buying a home. And your rate. I mean, a lot of people call us and they say, you know, rates are, you know, 2.5%. It's absolutely, they are 2.5% on a 30-year fix right now. But, you know, that involves having a very good credit score as well. Somebody that has a 640 credit score is not going to get the same rates as a person that has an 800 credit score. So it's very important to pull your credit scores. Oftentimes, a lot of the credit scores that you guys are used to on Credit Karma, and the various different sites that are providing them are very different than what we pull on our side, which we get them directly from Equifax, TransUnion, and Experian.
Sorry to interrupt. Regarding credit, our next section, we are going to have a quick 30-minute call just on credit. So we have that coming up in the next couple of weeks, because it's a really intense subject that some people really care about and other people don't. But that is going to be something we talk about. But you need to know your credit, right?
Yeah.
Katie, if you would like, I'm going to allow you to talk. I know your hand is raised. If you have a question, go ahead and ask it. Katie, are you there? You're muted. Let's see, you might have to mute yourself. If you're on a phone, I think you have to hit 9. Okay, I'm gonna leave you. Oh, your hand is down. Maybe you didn't have a question, it was an accident. Okay, no worries. So, okay, going back to credit, yes, it is important. At least as a minimum, I mean, I recommend get on Credit Karma so you know it doesn't affect your credit score. And I think it gives you something that you can see. And I've helped people through Credit Karma actually find out that they have something on there that they didn't know they did, and they were able to get rid of it. You can contest things that are wrong through Credit Karma, and that's going to help your credit score. So whether that number is exactly right, you know, I don't know. It tells you that you're logging into TransUnion and you're logging into Equifax and what your scores are. So, you know, Marty and I will have to debate about if how accurate those scores are. And again, they change every week too. So, you know, at least it's going to give you an idea. I think some of the scores, the free scores you get from your credit card companies, those are probably the ones that are very inaccurate. But yeah, maybe we should test it next time and have someone pull their Credit Karma score and see what yours are and see how different it is, so we know. We could share that on our next call. Okay, cool. Natalie, did you have anything else to say about the lending process before we get into more of, you know, searching for homes and getting into all that fun shopping part?
Nothing, just that I'm sorry that my computer got like too hot and then all of a sudden turned off. So I apologize.
You know what
guys.
you can talk about? The difference between Wells Fargo and Movement Mortgage and Arcstone. A mortgage, you know, a bank versus a mortgage banker and a mortgage broker. Yeah.
Yeah, absolutely. It's a good topic. So there's all different kinds of institutions, right? So you have mortgage banks, which is basically brokers. We have proprietary banks, which are banks that lend and keep everything in-house. Then we have depository banks. Depository banks are like the big banks, the Chase. With a depository banks have other things that are priority to them, right? So
yeah, you're still cutting out, Natalie.
That's not necessarily just.
Okay, Natalie is going in and out. Marty, do you want to finish that conversation on the difference between banks and mortgage bankers?
Sure, yes. So basically what the differences are the banks, like you said, like as Natalie was saying, is that they have checking accounts, car loans, and things of that nature. Mortgage is not their focus only. They do have a department that focuses on mortgages. What we do as mortgage bankers are our focus and understanding is going to be the mortgage process and making it a smooth process and having the most amount of programs available. And so that's you know, I think the main differences. And also the other pieces are going to be, you know, thinking outside of the box. We live in Los Angeles, and you know, there's a lot of people that are in the entertainment industry in Los Angeles, and there's a lot of people that have variable income sources. And so we think differently. Our underwriting processes are very different than a bank is. And so we look at it as a we're locally centric and locally, you know, not our underwriting is not in, let's say, New York, where they don't understand, you know, entertainment people, or essentially like things of that nature. So we just want to make sure that, you know, the person is being given the opportunity to get the loan and not just being declined for a reason that because the bank does not understand. The other thing is that, rates as well. I mean, with a bank, you're stuck with their own rates. We've got the capacity to get various different rate sources. And so, it's important for you to look at that and work with a banker that has the capacity to do that. Other things that, like, speed. We talked about that earlier. We work a lot faster than a bank does. We're a lot more nimble than a bank is. And then I think that's really the main differences that I
Yeah,
know.
I mean, we've found as agents that when we work with the mortgage banker, like, and we work with Marty or Natalie, the process is much simpler. It's easier on the client. The rates are usually better. When we work with the big banks, a lot of times we find that the rates change in the middle of the deal. And all of a sudden, a client's expecting to pay $3,500 a month, and then their rate changes. Or at the end of the deal, this is even more common. They say, "Oh, you actually need $20,000 more down to make this loan work for you," at the last minute. And maybe their loan contingency was removed. And we'll talk about what that means. And that puts your deposit at risk. So there could be a lot of issues that happen with some of the bigger banks that we've seen. So
I'm not sure, can you hear me?
yes.
Okay. I don't know what's going on. I just went into a different room. So sorry. Also keep in mind that when you come to a mortgage bank, we have a
Oh, frozen girl.
ton of different options. So we're not limited to any. You guys.
Yeah, I don't think your other room is any better.
I'm really frustrated.
I'm sorry. Maybe she'll find a better room. Okay, so let's go in now.
Okay.
Now you guys know what you're
Yeah.
qualified for, and say your range is a 750,000. Pretty common for a first-time home buyer. And now that we know that 750, you were hoping to get qualified for $1 million, but it's a little less than you wanted. So what does that mean? Can you buy a house? Can you buy a condo? Yeah, there are houses in different parts of LA. It's more difficult to find a house under $1 million. There's not as many neighborhoods that have that. There still are some, but it just depends on where you work, right? And how far away from work you want to be. And now with COVID happening, maybe you're able to work from home. So maybe you are able to explore other areas that will work for you. So maybe you're going to have to consider a condo, which is not a bad thing. To me, I think that getting into a condo as a first-time home buyer is what I did, and I'm so glad I did, because to me, as a first-time home buyer, I wanted more stability. So when you buy into a condo, you're paying an HOA, and you have those fees that you're paying every month. But those fees are basically going into almost like a savings account to take care of the property. So it's really rare that you're going to have, a really big bill that comes up to fix your property. In my condo, I've had one assessment for $1,000 over the last 15 years, and my dues have gone up and down by $20 here and there, and that's about it. So that's really, really stable. When you're in a home, if your roof goes out, it could be a $20,000 deal. You have a sewer that goes out, it could be a big deal. So there's more risks and variables when you're buying a home compared to a condo. Of course, when you have a home, you have a yard, you don't have someone living above you or below you. There's pluses and minuses for both, but they're both really, really great options. And just know that a lot of people don't want to buy a condo because they're afraid that, okay, I have to pay an extra $400 or $500 a month for HOA fees. Well, a lot of that goes to insurance costs, maybe earthquake insurance. It goes to pay some of your utilities, and it's also going towards a savings to keep your property maintained. So, you're going to have those same costs pretty much when you're buying a house, maybe even more. So don't think that you're wasting money on HOA fees just because, you have that. It goes to something that's going to benefit you. So there's a lot of areas, for example, I have a client right now who's looking for a home around 1.5, and she wants an absolutely great school district. Well, what are some areas that are working for her for that? There's a lot of great areas in the Valley. Sherman Oaks, Studio City, have amazing school districts. award-winning school districts, and you can get, 2,500 square foot house for that. If you're going to be in West Hollywood or somewhere else around here, some of the school districts aren't quite as strong, and you're going to get a much, much smaller house. So you kind of have to weigh what's the most important thing for youth. Is it school district? Is it the size of your property? Is it a walkable neighborhood? All of those things you'll have to discover with your realtor, and that's what we're here to help you do. Tim, do you want to give us maybe just like a brief overview of kind of one of the most popular areas, I think, in LA right now is South LA, with the Expo line coming through, new museums and developments, you're close to downtown, you're close to the freeway, houses are more affordable, all these amazing things. Like, you live in that area. What's your experience been there, and what do you kind of see for that neighborhood moving forward?
Well, as I mentioned in my own journey, I moved here in 2013, and it I was surprised. I first got off the freeway to look here, and I'm like, where the hell am I? I mean, I just didn't, it's down by USC and blah, blah, blah. So it was kind of a different, I had to kind of quickly reassess the area. And I'm finding that as far as location goes, it's so much better than living at the beach. The problem with the beach is you're close to the beach, which is great, but you're not close to anything else. So everything's a drive. So you're much more centrally located. The area is gentrifying rapidly. And, the crime is still a bit of an issue here, but it is rapidly decreasing. I have a client that's looking, she wants West Side, $1 million single family home. And I did cast a wide net, and what was coming up, nice affordable houses, nice houses in walkable neighborhoods, was View Park, Leimert Park, where I live, and Inglewood, Windsor Hills. These are all kind of clustered in South LA. So it is, as Anthony mentioned, on the west side, it's getting hard to find a house under $1 million, but there's a fair amount of inventory, even at the moment, and things that have recently sold in the nines, upper eights to $1 million here in Leimert, and Inglewood is even a better deal.
Yeah,
Plus, you also have...
The only properties I've seen that are under $1 million, and they're going to be maybe like 960, 990 on the west side, are right next to the freeway, right along the 405 and the 10 where they cross. That little corner right there, there's a few houses that'll pop up for about $1 million. And I haven't tracked them too much recently, but I'm guessing they're probably selling for over $1 million. I mean, last year even we were seeing some properties in Mar Vista and in that area for around $1 million, and it's already over. They're over that now. Culver City, you can't really find a house under 1.5. And their school districts are amazing, but there's some really cute townhouses and condos. So one alternative, in Culver City around 800, you could have this gorgeous townhouse and a great community pool, tennis courts, everything there, and be part of a great school and still have, a large property. So, the realtor that you choose is really important to help you discover new areas, because inventory is so low that it's very difficult to say, I want to live in this small pocket only. Because the chance of getting a property there is going to be difficult. And there might be other areas that you're just not even aware of that you might even enjoy a little bit more. So, sorry, Tim, go ahead. Keep going.
I just wanted to add to kind of riff on what you're saying is like, yeah, my $1 million example was single family. You can definitely do condos on the west side for a lot less than that. And there are beautiful condos in South LA for even less. There's a lot of new construction right near the train stop. On Expo, it's called Expo Walk. It's a new one, and there's a tons more being built that are, beautiful, huge townhomes for well under $1 million.
And so, for example, say you're in West Hollywood, starting price for a condo now for a 1-bedroom is maybe around $525, something like that. Marty or Natalie, like, what's a mortgage payment look like for that?
So on a 525 purchase, if you're looking, sorry guys, if you're looking to put down, should we do a comparison on like a 20% down? What are your thoughts?
No, let's do less. This is a first-time buyer. They're renting right now for $2,800 a month. Can they buy a 1-bedroom condo?
Yeah, absolutely. So if they do like a 5% down or 3% down, you're looking at a payment of let's see here, like $2,100, just the principal and interest is what the payments would look like. And then you've got
I'll tell you, I just did it.
I'm sorry? Oh.
$2,100 principal and interest. Then you have your taxes and HOA.
Then you've got your property taxes and HOA, and property taxes would be about $572 a month. So let's say like $600 a month between property taxes and insurance. And then your HOA, let's assume what, $500 would be the insurance, or less. What are your thoughts?
Less, like one building, say 350.
Okay, so 350 altogether. You're probably looking at about a $3,100, $3,200 payment, which is very close to what rents are.
And that's with little down, 3 to 5% down. So okay, cool.
Without the tax.
Sorry, Natalie, we're still getting robot Natalie.
There's like a nice tax write-off.
Oh, tax, I think I heard you say tax break, but yes, that's definitely something else you need to talk to your tax person or mortgage broker about, because you're getting a huge write-off every year. So say that you were paying, $2,800, $2,900 in rent, and now your total payment's going to be, oh, Natalie, I see you clear. Better, maybe this will work. With that tax break, it may offset that, where it's like you're paying the same thing. So do you want to touch on that briefly, Natalie?
Yeah, so if you're at a 3 or 5% down payment where you have mortgage insurance included, so the payment's a little bit higher than what you would pay in rent, let's say, always consider that you have this tax write-off, because the mortgage interest that you're paying is real. Like, you get that as a refund every year. I didn't believe it until I actually had it happen to me. I finally bought a house and I finally received back triple in my tax refund at the end of the year, triple. So it's a real thing to consider. Even if you're going to end up paying $500 more a month than you were in rent, or $700 more a month than you were in rent, you must consider the tax write-off, because it's a real refund, and very important to note in your buy versus rent comparison, because again, like in rent, you never see that money again. But when you purchase, you actually see that money back to you. So sometimes you do have to kick in more money a month, but it's so worth it.
Exactly. And I mean, that was kind of an eye-opener the first time that, Natalie, you kind of said it, like, it's like every time you pay a mortgage payment, you're putting some money back into your bank. It's like a forced savings account. And just that word, forced savings, I'm like, okay, so by buying a house, it's forcing me to save money every month. I've been wanting to do that anyway, and maybe I have been doing that anyway, but now when I own a property, there's several $100s a month that are just going into the savings account. So it's a win-win. Yeah.
I call it an equity bank account. It's a bank account, but only with your equity, Yeah. So you're putting into that bank account every month when you pay your mortgage, because you're just paying down the loan, which means you're basically building more equity in the property you own.
Yeah, it's pretty exciting to see, each year how your equity changes and grows, and yeah, it's awesome. So if any of you out there, let's get into the purchasing part now, because we are probably going to try to wrap this up sometime soon. And the first step is, once you figure out the area you want to live in, and you're going to write an offer, and you've got a house, maybe there's multiple offers. Your agent, again, is going to guide you through that process. Writing a personal letter is something that works sometimes. So your agent will have to let you know if that's something you should be doing or not. But you write that offer, you get an offer accepted. And again, I said multiples. Yes, there are still multiples in this crazy COVID market. Inventory is very, very low. So especially entry-level homes that people are buying for first-time buyers, there are multiple offers a lot of times. I'm starting to see some houses sit a little bit longer. So there's maybe, some hope where it'll be a little bit easier to get in. But there are multiples in some houses. They're not going someplace, well, it depends on your neighborhood. Your agent is going to be the one to guide you on the price that you should be offering. So say you get in, you write an offer, your offer gets accepted, have a glass of champagne, celebrate. The next thing that's going to happen is the listing agent will ask you to put in a 3% good faith deposit into escrow. So within the first 3 days, you should have 3% down payment, 3% deposit ready to wire into escrow. So escrow will hold it for you for the remainder of the deal. That 3% that goes into escrow, you can use that money later for your down payment, for closing costs, for whatever you need. So it goes towards that. But at the beginning, that 3% needs to be held at escrow, which is like the mutual party that's going to help you through the process and be that kind of like that mediator and holds your money and distributes money for you through the escrow process. So you'll wire the money to escrow, and then the next step after that is you want to do a home inspection. You know, the first thing to do is set up that home inspection right away. The general home inspections run about $400, and an inspector will spend, you know, at least an hour in your property, depending on how big it is. And they're going to look at all the different systems. They're going to look at plumbing, give you an idea, electrical. They're going to look at all the appliances, all the different outlets, and make sure that the house is, you know, let you know everything that's possibly wrong or needs updating in the house. So, I mean, Tim, do you have any experiences with inspections? Anything you want to kind of chime in on that? It's just, it's a great opportunity for the buyer to explore the home and find out what they're really buying. And if you find out things that are wrong, right, you're able to negotiate that or back out. So any experience, anything you want to say about that?
Yeah, definitely wanted to. Anthony hit it right on the head as far as one of the things that it will, two things it will do. One is you'll know what you're getting into. And the second is we have leverage then to go back through escrow and negotiate usually a credit towards your closing costs. When I bought my house, I didn't have to pay any closing costs because they gave us they gave us a credit that was equal to that. There's other things that we do. We just had a long conversation at the office about how we almost always do a sewer line inspection. That's because after your primary, you can also go through and get secondary inspections. You can have a foundation person come in if there's something a little off. I always do a sewer line inspection regardless because that's the only way to really know. And that's a big hit if something goes wrong. And going back and forth, and you really get to know your property while you're in escrow. While you're doing that, and that's also a positive thing. But yeah, and it's something that we definitely use to our advantage of the buyer when we negotiate for them.
Yeah, so a lot of times if it's a condo, you know, little things will come up, not a big deal. Sometimes in a house, you know, we definitely want to check the sewer line because that could be a big ticket item. If you're on a hillside, you might want to do a geo inspection and see what kind of ground you're actually built on. I mean, if the house has been there for a while, you're probably going to be fine, but it's still something you might want to investigate. Houses foundations, you know, in LA, we have a lot of older houses that are on different types of foundation. So you may want to have somebody look under the house and see, has an earthquake cracked it? You know, is it up to retrofit standards today, or would you want to maybe reinforce it a little bit more? So those are some things that you'll want to look at. And when you find these findings, again, you're able to ask the seller to either repair them, ask for a credit, or back out. The seller doesn't have to do anything. So if you're in a multiple offer situation and you're asking for, you know, $50,000 of work to be done, you probably won't get it. But if you don't get it and you're not comfortable with the house, you'll be able to back out of the deal and get your deposit back. So it's a great time to just really understand what you're getting yourself into. And hopefully you'll get a few credits and get some of your closing costs paid for. That's, you know, pretty standard. We do usually get some type of credit to help you to pay for some of your closing costs. So that happens then. Then the next part is Marty and Natalie are going to send out an appraiser. Do you guys want to talk for a minute about that?
Go ahead, Natalie.
Sure.
So exciting.
Let's see if I can. Yes, so we will send an appraiser out. Normally when you work with a mortgage bank like Marty or I, it is a local appraiser that we work with all the time. So we know their value, so to speak, and that they understand the area, which is very, very important. So we send an appraiser out. Nowadays it's taking about 7 days to get the report back in. So from when we order it, they'll schedule an inspection with the listing agent. The appraiser will go out, we'll look at the property, you know, they take measurements, they look at what we call comps, which is similar homes in the area that have sold in a similar time period that we are in, you know, within 3 to 6 months or so, depending on the availability of comps. And then they draw up a report based on that. So they're going to basically tell us, the lender, this is what I think the value is, regardless of the purchase price. This is what I think the value is.
And we as lenders go off the value on an appraisal report to what we will lend on. So if the value is 600,000 and you're bringing 10% down, you bring in 10% down of the 600,000 because that's the amount that we are comfortable lending up to. And then the appraisal comes in a few days later, and then you guys can sign off on your contingencies.
Yeah.
There's a good thing now, actually. Incredible thing that's been happening is that we get a lot of appraisal waivers. So depending on your down payment, depending on the strength of the file, if it's very strong, then we won't even need to do an appraisal. The system is deeming the purchase value that you are getting it for already stable and correct, basically. So we get an appraisal waiver. We don't even have to do one. You save the money, and we save the contingency and the waiting on it.
So regarding a lot of times buyers right now are having to offer over asking price in order to get the property. And sometimes the buyers are afraid. They're like, am I overpaying for this property? And your realtor will discuss with you if, yeah, hey, this is the limit you should maybe go at, or it might be up to you as well to figure out your limit. But know that there is an appraisal that will happen. And if the bank feels that your property is worth $50,000 less than what you offered, at that point, if you have your appraisal contingency in, which usually we do, you'll be able to back out of that property, or again, renegotiate with the seller and say, look, it appraised $50,000 less. What I'm requesting at this point is that we reduce the purchase price $50,000. Or maybe you'll meet in the middle and reduce it $25,000, and you'll be able to change your loan or come up with a little bit more of a down payment to make it work. It'll be a new negotiation, but you will have the final say in, do you move forward with this property or not, based on what it looks like. So you are protected from that. So once the appraisal is done, awesome. We move forward to the next step. There's one more contingency you have in place, is your loan contingency. So until your loan gets fully approved, if your loan doesn't get approved for some reason, you can back out of the deal. So usually our loan contingencies right now, 14 to 21 days. We're seeing sometimes we're doing even less. If you're a great buyer and you have all your paperwork in, and Natalie and Marty are able to approve you right off the bat, they may say, hey, just give us 5 days. We just want to look at the HOA docs. Or, you know what, we don't need a loan contingency. You're amazing. You don't have to write it in. The only time you would not write in that contingency is if you're trying to make your offer more competitive. If you're the only offer in, you just leave the loan contingency in there just in case something was to happen, because it gives you out to back out of the deal and get that 3% deposit back. So once your loan is approved, we'll remove that contingency and move forward toward closing. Escrows right now average are 30 to 45 days, pretty standard. And once that close date comes, hallelujah, we get the keys. But right before that, there's a little process that'll happen. We can talk, maybe Marty, if you want to briefly. The buyer needs to sign a closing disclosure and loan docs. So how does that end process work with you?
Some guidelines changed back in 2010 where the borrower has to get a closing disclosure. It's just a document that basically outlines your rate, your fees, and any and all terms of your loan, and any fees that you'll be paying on this final document. You'd have to sign it, acknowledge it 3 days before you sign your final loan documents. This is I like this process because a lot of times where buyers used to go to closing tables, they would be like, oh no, I don't agree with this. And there would be last minute issues. This gives you plenty of time to review all the documents, to remove any disputed items with the lender or any other items that might be on there, and just get it, get it ready to closing for a smooth closing. It's definitely made a change. It does create some delays sometimes, but usually with ours, and I think the same with Natalie's company, is that we send out a closing disclosure very early on. So you'll know your fees way early. Even like I would say at the time of approval is what we end up sending it out. So that way, you know, there's not going to be any changes. There's no surprises towards the end of the transaction. That's a really reassuring way.
Yeah, the big banks don't always do that. You know, a lot of times they're sending them out the very last minute, and you're like, wait, what? My payment is this, or my rate is this. I thought it was this. And you're at the end of the deal, and you're like, well, what do I do? I can't really back out now. You're like almost forced to accept it, and it's not right. So yeah, Natalie and Marty will get those out to you right away, and you'll know what your payments are going to be, what your rate is, all of that info from the beginning. And then how do loan docs sign? You know, at the end of escrow, they're not signing their loan papers till usually the very end, right? So how does that work?
So your escrow officer, which is the neutral third party company, will reach out and say, hey, by the way, your loan documents are here. Come on over to our office, or we'll send somebody over to your house, and they will make it very convenient to you. They'll whatever works for you. With COVID, it's been very interesting. You know, we want to make it as you know, safe as possible. Some people are wanting to sign outside, and so it's a very simple process where the notary comes to your house and explains the documents that you're signing. Hopefully, we would have already gone through that with you before closing, so you would have already know what you're going to sign. So it's just a you know, an acknowledgement of the final set of documents. I usually say, you know, I got in this business 26 years ago. This set of documents were probably this much. Now they're like this much. And it's a lot of documents you'll be signing. So exercise your hand, and also, you know, get ready. It's like being a celebrity. You're just basically autographing. But with that said, I mean, a lot of the documents are just legal jargon stuff. The most important pieces you'll be signing are going to be your note and your deed. That's what I focus on generally. But yeah, it's a lot of documents, and we'll go over those with you and explain everything.
Yeah, it's how it'll happen, you know, a couple days before you close, and notary will be there to guide you as well, and just, you know, get that done. It is something that needs to be signed in person with the notary. The rest of the real estate disclosures and documents that we give you as an office are going to be done through DocuSign. So that will happen, you know, without any contact with us. You can just click and sign on your phone, and a lot of the escrow documents will be like that too. But there are some things that need to be signed with ink still. And during COVID, you know, everyone's taking precautions, and you know, you might want to meet outside and just get those signed and get that done at the end. And then your loan will fund, and then title will go down to the county and turn in the new deed to be signed to be in your name, and title records and closes, and hallelujah, and celebration. And then the realtor's going to come and give you your keys and move into your new house. And that is your first day of starting to build wealth. So now you're on that path to building wealth. Like most Americans who've built wealth in this country through real estate, now you're going to be one of those people. And it's an amazing experience, you know, to have that pride of ownership, and to be able to paint whenever you want to, change the floors, you know, do so many things to really make it your own. You know, you're buying into this home that's just a shell when you buy it, but all this love and emotion and these, you know, really great experiences will start happening in there, and it just makes that place so special to you, you know, as being your own home that you own. Plus you're building wealth, you know, so it's like, it's such a great opportunity. You know, I always think back like to the story of my family owning real estate, and, you know, they bought a property about, I guess, 40 years ago, and it was a real struggle for them to buy it and to get the down payment. They had to borrow a little bit of money for the down payment from, you know, their parents to help them, but they got in and they got a house, and you know, were able to make their payments. And there were times where the economy got really rough, and my dad works for himself, and he was needing money. And luckily he had his house, and he had owned it at that point for 12 years, and was able to take some money out and take money out of his house to help pay the bills and keep his family going. If he was renting at that point, he wouldn't have had that opportunity to do that. So he was able to take some money out, and then, you know, the economy got better, his business got better, and things started growing, and, you know, he's building more and more equity. And now at this point, you know, he has the house pretty much paid off and has a lot of equity in it, and he'll be able to use that equity to retire off of. And it's been just such an amazing experience, you know, for him to have that. So the sooner you can get on the path to buying, the better off it's going to be for you. All of our clients say, I wish I would have got in sooner. And it's just, it's going to be such a great experience for you in the long run. And, you know, like Tim said, your lifestyle might change for a little while, but your lifestyle over the period of your life is going to get better because you own. It might temporarily take a step back. Maybe you were living in an apartment that was 1,200 square feet, and now you're in a condo that's 900 square feet. You know, there might be some changes, but overall, in the long run, it's going to be a much safer, much more important, more stability, more happiness, more wealth in your future by taking that step back right now in order to get into this process. So that first hurdle is just, you know, putting your ego aside and saying, hey, I might have to change my personal situation a little bit and some of my spending habits and my lifestyle. But it's going to be the right thing to do for your future, I promise you. So thank you guys so much for joining us. Check out our other videos on YouTube. We also post them on our Facebook page. We have seminars that happen all the time. So, you know, stay tuned for that. We always advertise them on the Collective Realty on Facebook. And we'll keep providing more education for you, you know, through our YouTube channel. So if you're looking for a great agent, please go to the Collective Realty. Again, we can work all over Southern California. Some of our agents are in Northern California, and we have great relationships all over the country as well. So so happy to have you guys join us. And thank you, Tim. You did an awesome job. You're a great realtor. Thank you for being here. And Marty and Natalie, you guys are so supportive of our office and our clients, and our clients really, really love you. So I'm very lucky to be in business with both of you. I mean, just the patience that you have with some of our clients and us as agents. And I know it's a very, very busy time for everybody right now. So thank you guys for everything that you do for us. And I wish everyone a great weekend and all the success. And I'm looking forward to helping you get on the path to building wealth through real estate. Have a great weekend, everyone.
Thank you.
Thanks, everybody.